Hi, I'm Mitchell Roth, managing partner of Much and a member of the corporate and M&A practice group.
I'm Mike Shaw. I'm the head of the firm's private equity and M&A group. Today we're going to talk about representation and warranty insurance.
Mike, we've been doing deals for a couple decades together, long before RWI was a product. Tell me about the evolution of RWI and where it is today.
So, when we first started working with RWI, it was really for the larger deals that we were working on. Over the course of the past 10 years, we've really seen the evolution of the product to become more available on some of the smaller deals that we're handling. As a firm, we work with strategic clients, but also private equity firms, and we work with some of their platform acquisitions, but also some of their add on acquisitions. And now we're seeing RWI policies available on those add on acquisitions, which aren't quite as sizable as those original acquisitions that RWI was available for. So we've seen RWI policies available for all different size acquisitions. A lot of our clients are now putting it right in the letter of intent. And from the beginning, just saying that we're going to have an RWI policy in this deal. Really, the only negotiation with the sellers is over the terms of the RWI policy. Who's paying for it? Who's going to pay for the premium? Who's going to pay for the deductible? And they're putting it right in the letter of intent from the beginning.
Mike, what size policies for add-on acquisitions have you seen?
So recently, we've seen policies underwritten for $1 to $2 million, which was unheard of even a few years ago. So the value of these policies has really become a lot smaller as underwriters have become more comfortable writing smaller policies. So as the use of RWI policies has become more mainstream, sellers counsel has become more adept at understanding how the use of an RWI policy filters throughout a transaction, in the use of it throughout the purchase agreement and the transaction as a whole. One of the concerns that a buyer always has in a transaction is what happens if there's an indemnification claim. Typically, a seller will go to work for a buyer in a transaction once it closes. When an RWI policy is involved, a buyer doesn't have to worry about going after a seller who is now working for them. Instead, a private equity firm can seek indemnification against an insurance company. That makes a private equity firm feel more secure if it has an indemnification claim, that it doesn't have to go against one of its employees. Instead, it can go after an insurance company. Mitchell, one of our strategic clients has a unique approach that it has to its RWI policies. Can you tell us about that?
Sure. Michael, I have a client who's highly acquisitive. We did somewhere around 30 transactions last year. And one of the hurdles of some of the smaller deals is we have unsophisticated sellers. With unsophisticated sellers, it's hard to have holdbacks and indemnities that have often cratered deals. With a global solution, we went to the insurance market and asked for a product that we don't have to keep coming back for each add-on deal. We found a solution where all of our transactions of any size and shape will be included in the policy. That has made transactions, large or small, much more efficient and easier to complete.
So, how do you handle each subsequent transaction?
Like your homeowner's policy, where you have a rider for cars or jewelry, every time we do a add-on transaction, we have a separate endorsement. The policy's already been negotiated. The only thing the endorsement does is deal with pricing and carve-outs.
What are the benefits to the transaction of having this in place?
With the smaller transactions, especially, and unsophisticated sellers, we're able to get deals done where sellers would never sell to us because of A, escrows, or B, the indemnity risk.
Have you seen this type of product in the marketplace before?
I've been hearing about this product for the last year or so. With the number of transactions our client is undertaking on an annual basis, we went to the market specifically and built one for our client. This is the first time we've ever used it or seen it, and has made all of our transactions way more smooth and efficient and cost effective.
How does the pricing on this policy compare to other RWI policies that you've seen previously?
The beauty of this policy is all of our pricing has been negotiated up front. We have pricing certainty, which we have not had with other transactions. Having this policy in place, there is no risk of going to the market and worrying about insurability at the time of transacting.
I think that's really interesting to hear about the type of policy that your client's putting in place. I could see where a lot of private equity clients would put uniform policies in place among each of their portfolio companies.